Hey everyone, welcome back to Corporate Decoder, the place where we read between the lines of corporate filings and sometimes find actual buried treasure. Get ready because today we're digging into Jefferies Financial Group Inc.'s latest report, and let me tell you, it involves a whole lot of debt, but maybe for a good reason. Make sure you are subscribed because we break down these filings so you don't have to. And if you want to dive deeper into these discussions, join our Discord community linked in the description below. So what is this document all about? Well, it is an 8K filing, which is basically a report on major corporate events that shareholders have a right to know about. Think of it as the company announcing something big happened, and they need to tell the public right away. In this case, Jefferies Financial Group Inc., which we'll just call Jefferies from here on out, is announcing they've issued a new series of notes. Now, this is where it gets interesting. Jefferies is issuing a massive $1.5 billion worth of what they call senior notes. Think of these notes as bonds, essentially the company borrowing a ton of money from investors. These specific notes come with a 5.500% interest rate, and they are due in 2036. So Jefferies is taking on significant debt, but they are doing it to raise capital. The report tells us that these notes were registered under a shelf registration statement. That sounds complicated, but it basically means the company had previously filed the paperwork to be able to issue these kinds of securities whenever they needed to. They also tell us the sale of these notes closed on the 16th of January 2026. So how much money are they actually getting after all the fees and costs associated with selling these notes? Well, they estimate the net proceeds to be around $1.48 billion. That is a huge chunk of change. And what are they going to do with all this money? They say it is for general corporate purposes. This is pretty standard language, but it can mean a lot of things. It could be for expanding the business, paying off other debts, investments, or even just keeping the lights on, when companies use funds for general corporate purposes. It is always good to watch closely how that money is being deployed to understand the true strategy. This filing also gives us a snapshot of other debt Jefferies already has outstanding. For example, they have 4.850% senior notes maturing in 2027 and 5.875% senior notes due in 2028. They also have notes with different interest rates and maturity dates. This shows us that Jefferies operates with a significant amount of leverage, meaning they rely heavily on borrowed money to fund their operations. And of course, we can't forget their common stock, which is traded on the New York Stock Exchange under the ticker symbol JEF. This tells us that alongside their debt, they also have equity investors who own a piece of the company. Now, for my take on all this, Jefferies Financial Group Inc. is clearly in a growth and financing phase. They are actively raising capital through debt issuance, which isn't necessarily bad. Companies often do this to fund expansion or strategic initiatives. The fact that they have a shelf registration already in place suggests a planned approach to managing their capital structure. The biggest takeaway here is the sheer scale of the debt being raised. $1.5 billion is a lot of money, and while the interest rate of 5.500% is not exorbitant, especially in the current economic climate, it adds to their overall debt servicing obligations. The use of funds for general corporate purposes is a bit of a black box. It could be very positive, fueling future growth. Or it could be a sign that they need cash for operational needs or to manage existing liabilities. A key risk here is interest rate sensitivity. If interest rates continue to rise, the cost of servicing their debt will increase, potentially impacting profitability. Also, a substantial debt load makes them more vulnerable during economic downturns. Investors will be watching very closely how Jefferies uses these funds, and if they can generate returns that justify the cost of borrowing. The diversification of their existing debt instruments with various maturity dates and interest rates shows a strategy in managing their debt ladder, but the accumulation of more debt means increased financial risk. In conclusion, Jefferies is making a significant move to secure a large amount of capital. The success of this strategy will depend on how effectively they deploy these funds and whether the market conditions will allow them to generate sufficient profits to cover their increased debt obligations. It is a bold move, and investors will be looking for signs of strong operational performance to back it up. Alright? That is our breakdown of Jefferies Financial Group Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.